So, guys, evening everyone. Greetings of the day. Thank you so much for joining in, all the listeners. I'll just give a little bit of introduction about myself. I'm Manan Shah, your host for the evening. I'm a corporate lawyer by profession. I currently work in the investments team at Equanimity Ventures. I've had past experiences as a PVC lawyer at ENB Legal and as a business analyst at IPV. So let's welcome our guest today for the evening, Mr. Rajesh Sehgal. A little bit about him. Rajesh is a seasoned investor with more than 2 decades of experience managing early stage private equity and public equity funds. Had been deeply engaged in the Indian startup ecosystem since 2007. He's invested into about 25 plus startups. He's a graduate from Wharton and XLRI, specializing in finance and marketing. Rajesh also holds a CFA charter and a postgraduate diploma in securities law. His career began at SBI Caps in 1996, followed by a 17-year tenure working at Franklin. He also worked quite closely alongside the great Dr. Mark Mobius. So, hi Rajesh, how's it going?
Hi, Manan. Hi, thanks for having me. And you just made me sound very old.
Yeah. So, Rajesh, I have a couple of questions for you today, which cover the VC landscape at large and how it basically correlates with the startup ecosystem, the kind of VCs, the value that VCs add to the startup's life, and most importantly, how would investors like you and me benefit from something like this? So, let's begin the session.
Yes, yes.
Interesting. So let me start with asking you something very basic. What is venture capital and its typical engagement with startups? Also, in comparison to traditional financing options that we have today in the market, right? Why would a company go for a VC raise?
Very interesting.
Yeah.
Hey, it's a question I've not been asked in a long time. What is venture capital and why venture capital? Very interesting. I think I'll try to keep it very basic without throwing too many terminologies and jargon that every industry uses. So let's keep it small, simple, and quick. So I think what is venture capital is very simple. It is capital, which means money that is used to fund ventures. Now, when you say venture, it essentially has the sound of new in it. So it's something new that is happening. You're setting up something new. You are an entrepreneur. You have an idea. You want to execute it in the real world, and to do anything, you need capital. And if you want to do it fast, you want more capital. And in today's day and age, everyone wants to do everything quick. You want it now, right? This is the era of Instamart and Zepto. Everything has to happen right away.
Gen Z explanation.
Yeah. Yes. So I think to pander to this requirement of wanting to grow faster because you're very ambitious and also because the environment allows you to, there is a need to raise capital fast and a lot. And that I think is venture capital. So venture capital is any money that can help you set up a venture fast and quick and lift it up the ground and into the real world. So that is venture capital. I think that was one part of your question answered. The other part was why would someone want to raise venture capital in the first place? I think that's this question. Why venture capital? You're now trying to justify my own existence. Why venture capital? So I think if you look around, you have different, and I'm saying take a macro look. Look at the entire overall economy. In an economy, there are pockets of safety, and then there are pockets of risk. If you were to see, and there are two different ends of the spectrum. So on the safer side, you have bank fixed deposits, right? You have government treasuries, government securities. They're all very safe, right? So there's a lot of safety there. But then from an investor's point of view, the return on those investments are called technically risk-free return. Essentially, it means it's the base minimum level of return that you will get for capital that you've deployed there. On the other end of the spectrum is capital that you've deployed into risky ventures. You want to take a lot of risk. Now, when you take a lot of risk, you want to be compensated with very high returns, right? With abnormally high returns. And that is the other end of the spectrum. Now, question is, when you are starting a new venture, who will give you money to run this venture? Will a bank give you money? Will your friends give you money? Will your next door neighbor, high net worth, rich dude give you the money? Who's going to fund you? And I think this is where the role of venture capital essentially comes in. Any fund like ours, like Equanimity, where we are willing to stomach a lot of risk with our investments, with the belief that if we partner with the right set of people, setting up right kind of businesses in the world, which will scale up and grow fabulously well, we will make a lot of return in the bargain. So therefore, venture capital.
Got it. That's a great start to the event, though. And also it set a base towards what it is about. So moving on, one more question to you, which is quite basic in a term way. Why are you inclined more towards the early stage startups than the late stage guys? And what specific qualities do you see in these kind of companies?
Yeah. Yeah, again, a very nice question. Why early stage versus why not late stage? So just give you a backdrop. I mean, you introduced me very well, and I'll just lean on that introduction. So, I've done public market investing for more than 25 years. I've done private equity in 20 of those 25 years. And I've done venture capital investing and angel investing for now nearly 15 years. And so I can speak from experience of what are the differences when you invest in mature, large listed companies versus growing, fledgling, mid-sized companies versus starting up new ventures. They're all three very, very different. Now, why we chose to focus on early stages, because in India, if you look around, and you just have to be staying in this country or having visited this country, you will realize that there are a plethora of problems, multitude of problems everywhere, right? And all these problems need a solution. Some of these problems can be solved using technology. Some of them can be solved using technology and some newer business models. And actually, some of them can be solved by the government, but the government moves at its own pace. Given that we are, a very large country in terms of area, geography, and also in terms of population, so those things take time. Now, the Britishers, when they ruled India, they famously called us a nation of shopkeepers. My view is they actually should have called us a nation of entrepreneurs, because every small shopkeeper is an entrepreneur. So this whole entrepreneurship is, it runs in our DNA. We understand what is, we call it dhanda, what is jugad. It's all in our DNA. We know how that works. So I think in a nation which is full of entrepreneurs, the best place to deploy capital and to help support the ecosystem and help support the nation in terms of its nation building and infrastructure building is actually in the startup stage. So, and of course, as an investor, if we are investing in early stage startups, we are taking that much more risk, and therefore, we expect that much more return. So we're also being greedy here, but it's all in the end, it's all good. It's a win-win.
Yeah, that's great. So this question, very next question is especially for the investors on the forum. Venture capital funds typically have a long-term investment horizon, which entails a fund to block money for a very long time. From an investor's perspective, why would one want to park their money for 10 long years and stay put in a VC fund like us?
Yeah.
Yeah.
Again, a very interesting question from an investor standpoint, and I think there are a few ways to look at this aspect. Let me talk to you from our point of view, from the investor or a VC standpoint. You got to understand that we invest money in businesses for a period of 2-3 years. The way a VC fund works is that if you want to invest 100 rupees, you do not give us 100 rupees. We do not take 100 rupees from you on day one. Compare this to a mutual fund. If you want to invest 100 rupees in a mutual fund, you will go to the mutual house, fill in the line, etc., etc. Your 100 rupees is gone, and invest. With a VC fund, you will commit 100 rupees and you will invest that 100 rupees with us over a period of 2.5 years. which essentially means every year you're giving us, say, about 25-30% of what you've committed. Now, because we've not taken your money right on day one, your duration of money, the time period for which your money is stuck with us is actually limited. Also, what we do on the other hand is that once we invest in companies, whenever we sell those investments, we will return the money back to investors. So the investor, even though we are called a 7-year fund, investor's money is not with us for 7 years ever, right? So we've taken first 2-3 years, we've returned money as and when there are exits, which essentially means, and there's some data to support this, that the investor's money is invested in this class in a certain for about 4 years, roughly, as a thumb rule. So I think it's not really 9 years, 10 years, 8 years, all those numbers out there. Yes, door to door, it is a 7 years, 8 year kind of fund. But for effectively, your money is stuck there for like 4.5 years. So that is one way of looking at it. The other way of looking at it from an investor standpoint, and I can attest to that because I've been an investor all my life, is that as an investor, what you're looking for is a higher rate of return, but one that comes to you steadily, year after year after year after year. Now, that is what a VC fund can give to you, which a market fund cannot or is unable to do that so easily. The reason for that is that because we're taking higher risk, and if we are right and we give you the higher return, you will get returns compounded. So the way it works in our ecosystem, the early stage ecosystem, venture capital investors or angel investors who are participating in funds like ours, you get, let's say, a 25% return per annum. You don't get it every year, but you get it compounded at the end of it all, right? Or as we return the money to you. Now, stock markets on the other end, in bull market, give you 20, 30, 50% return. In bear markets, they can give you -10, -20, -3. So if you are an investor who has a stomach to manage and live peacefully with negative returns also along the cycle, then the stock market is good enough. But of course, the stock market is a lower level of risk compared to early stage VC funds, which essentially means that your return profile is going to be slightly lower than the VC returns. So there are few ways to think about it, but I think actually VC is a different asset class. For any investor, the amount of investment that they're doing in terms of financial assets, my firm belief is that up to 15% of your corpus should be invested to longer term investments like a VC firm like ours. So we're not saying you put entire money into VC investments or early stage investments, but I think about 15% of your overall assets should be allocated to the asset class that we operate in.
Got it. Got it. So, I see a lot of questions pouring in. Yeah. So just a last question, a question from our end. That is, it's a very, very important question to tackle the buzzwords that are around today. What role do you see a new age technology like AI and blockchain play in shaping your investment thesis? How do you evaluate the risk and rewards associated with these kind of companies and the technology enablers that AI and blockchain brings?
Yeah, well, those are really the buzzwords of the day. Artificial intelligence, machine learning, blockchain, crypto, all of these things. I think this is testimony to how technology has pervaded our daily life, right? So everybody, a common man on the street, a young chap graduating out of college is aware of what is AI, what is ML, what is blockchain, how does it work, crypto, all of these are Bitcoins, all these are known things. So that's, I think, testimony to technology and its prowess. But I think simply said, as far as our investment is concerned, do not go chasing these new buzzwords, do not go chasing these new trends, because by the sheer fact that whenever anything new pervades our consciousness here, it comes with its own bag full of risks. So unless and until you are an expert in the area, so if you're a blockchain expert, if you're an AI guru, or if you understand what artificial intelligence is, how it can be mined, how it can be used, who's competing, and please remember, when it comes to blockchain or AI and all of these new technologies, It's no longer the small startup around the corner in the garage who's managing all of this. It's all the biggies who are into it. Whether it is a Microsoft, Amazon, Apple, Google, just name any of those guys, they're all in the fray. So you're actually competing with the best brains and the best deepest pockets, on the street. So therefore, one needs to be cautious. But that said, I think what we are not just globally but also in India is most new age businesses. Anybody who's setting up a new business is actually integrating the power of AI into their business. They're actually integrating blockchains into if whatever business they are into. So these have really become tools in the hands of smartness. I would encourage all of you who are out there thinking of startups or working in startups or investing in startups, do pay attention to AI, ML, blockchain, and every new thing that comes around the corner. And rather than chasing them as pure technology investment, companies and entrepreneurs and founders who are able to harness the power of these technologies in their businesses. It can be a fintech business, it can be health tech, it can be education technology, consumer tech, it can be any field. So all these new age things are becoming relevant for us very, very rapidly.
Also, just to add to what you said, I think it's very important for the investors like us to unwrap the wrapper, that is the AI wrapper that every company is bringing in today to us, that okay, we have AI and everything that we do. So it's very important for us to unwrap that and see that what the business is exactly, and what are we enabling out of that with the kind of technology that they bring in. So yeah, that's quite important. We
Very
have a
nice.
question by Kabir, which says, "Hi Rajesh, would love to know your thoughts on how you look at picking the right investments. Any tips you have for entrepreneurs when they pitch to the VCs like yourselves?" Yeah.
So you want tips for entrepreneurs, right? To pitch when they
Pitching to
pitch to VC.
VCs. Yeah, yeah.
I think a few things, just early in the day, I was conducting a session for VC Circle and sharing my thoughts with, audience who were largely founders and people who work in startups. And one of the things that I touched upon was exactly this. I think what you need to keep in mind, I think, the 10,000 things I could come up with, but just let's say pick the top two, three top of my mind. I think one is inspire confidence in the investor. When you get a meeting with a venture capital investor, typically it's a 1 hour meeting, roughly. Sometimes a 3-4 hour meeting, sometimes a 30 minutes meeting, but on an average, an hour long interaction. Now, in those 60 minutes, you will be touching upon so many things. You will be talking about, maybe you have a deck and you're presenting from your deck. So you're talking about all facets about your business, all kinds of aspects. Make sure that you leave an impression on the investor. Make sure that when you walk out of the room, the VC investor who has invested 1 hour of his time with you and you've invested your time with him, make sure that he or she has at least one or two ideas in their mind, one or two things that they remember the meeting by. So you have to leave an impression. That's extremely important. Look at it from the lens of our eyes. As investors, on a typical day, we would meet 3 to 5, 7 founders or founding teams, right? Everybody's pitching us their ideas. Everybody's trying to impress upon us how we should be funding them and giving them the capital rather than the other guy who's walked in. So it's kind of a crowded space. And I think for you to stand out, you have to leave an impression, however that is. That is one. And the second thing that comes to mind, when you're meeting any venture capital investor, I would recommend you be very transparent. I think as investors, and given all the things that are ongoing in the ecosystem, we've heard of names like okay, let's not take names, but quite a few large companies that have really slipped on the governance aspect and transparency and all of those things. So I think as investors, we've all gotten once bitten, twice shy. We all want to be very, very careful, and therefore we are always, at least now, seeking people whom we can trust, which means people who are transparent with us, people who are not hiding stuff. So in your meeting with the investor, do share all the glory about your business, but also, share things which inspire confidence in the investor that, okay, these are trustworthy people. They are being very transparent with us. So let's spend some more. So I think these would be the top two things, Manan.
Correct. Correct. We have a question by Aaron, which says, what key factors do venture capitalists consider when evaluating potential startup investments?
Oh,
Yeah,
thousands and thousands of things we look for when we're evaluating startups for investing. Uh, so I think if you again remove all the technicalities around investing, there are just three pieces that we focus on. The first is the founder and the main team, and I think everybody will tell you the same thing, but really makes a difference in terms of our understanding of people, our understanding of founding teams, and whether what has been their background, how do they think, how do they value money, how are they really believers in their own story, believers in their own product technology that they're building. So the founding team is the first thing where we start from. The second thing that we look at is the opportunity size. So this founding team is now trying to capitalize on a certain sector, on a certain business. Let's say it is something in fintech or health tech, etc. So as an investor, what is our thesis on that sector? Do we believe that the space is large enough? Do we believe that this business will really, become a $1 billion business someday? Pretty sizable business, if not $1 billion business, right? So these are the two things that matter. And the third thing, which is very logical, that matter to investors like us, is the bridge between these two things: the founding team and the opportunity. Now, what is the bridge between the two, right? And the bridge between the two is execution capability of the founding team to make sure that they execute well enough to make that plan that they have into a real business. And I think that is where investors actually end up spending most of their time to figure out and to make sure that this team of founders is able to execute on the promise. So this is what I would recommend, Kabir.
correct, correct, correct. So there's one question by Varun, which says, how important is a robust business plan and scalability for startups seeking venture capital funding?
Extremely important, very important. It doesn't mean that you will have to, if you made a plan, you will have to make sure that you're living by that plan. A plan is just that, it's a plan. It's some kind of a guidepost to you. In the real world, things may not move according to plan, like they seldom do. So things will go left, they'll go right, they'll go topsy turvy, all of that. And I think it's the founder's responsibility and the team's responsibility to make sure that their vision and their plan aligns to the reality on the ground. But I think for whatever it's worth, having a very robust business plan is the first step. It's not to convince investors, by the way. Your plan is not there to convince investors, even though we look at those plans and try to understand those plans. I think that plan is for yourself as a founder, as an entrepreneur. You are, when you try to put your thoughts down on paper, you yourself start asking yourself so many more questions. Oh, I thought this may grow and this may happen in 3 months. But you know what? When I'm going through all the numbers, I think 3 months is too optimistic. Maybe it'll take 4.5 months. And for a startup in the early stages of their life cycle, difference between 3 months and 4.5 months is it can be actually fatal if you don't calculate your cost and your money and everything properly. So I think a plan is a great starting point, Manan.
Correct, correct. One last question that we can take, which is from Lavanya. With your investments spanning diverse industries, are there any specific sectors or trends that you find particularly promising in today's startup ecosystem in India?
Yeah. So I think we are pretty sector agnostic. We do not focus on any sectors. We are really truly looking at founding teams, business ideas, and execution capability. Those three things that I mentioned earlier. But that said, I think I alluded to this earlier in my conversation where I said India has so many problems, and you just have to step out and you'll be faced with a few of them. Try to solve them for yourself, and there you go. That's a business. But from our point of view, I think we are seeing a lot of entrepreneurs stepping out there, wanting to build businesses in every area. I mean, consumer remains a big area. Consumer tech, retail, D2C kind of business models. Enterprise is another big business area that a lot of Indian entrepreneurs are setting up businesses in. So B2B, SaaS, etc. Fintech and health tech remain the two evergreen sectors. I think India, being such a populous country and geographically so diverse, I think any fintech or health tech has scope to grow. Despite even in the fintech space, we know that there is a Paytm, there are all these bigger companies, and everything seems to be done. I've got news for you: nothing is done yet. There's lots to be done. A lot, long way to go. So I think area-wise, just stick to what you guys know the best. Your team knows the best, and I think investors of all walks of life are out there. They'll find you. Just try to execute to the best of your capability. That's what I would say.
I think to add on to this, I think innovation is pretty much done in all most of these sectors. Now is the time for incremental innovation that's focusing micro on what consumers actually need, is what I feel. What do you think about that, Rajesh?
No, absolutely, no questions about that. I think innovation is it's becoming a way of life, and I think it's going down to the grassroots levels. We are seeing incubators and accelerators across colleges. And earlier it used to be only engineering colleges, but now we have these small pockets of incubators, accelerators in smaller corporates. SMEs are participating in it. Non-engineering colleges are participating in it, whether they are commerce-oriented colleges or general graduation colleges. So I think innovation is penetrating deep into the Indian business landscape. And I would tie this up with what I said earlier. We are a nation of entrepreneurs. So I agree with you.
Yeah, that's true. One last interesting question that I saw on the forum, that is, why does the media and the founders sometimes refer to venture capital as vulture capitals? Yeah.
Well, every movie has a villain, and
Yeah.
as you're seeing out there, there are investors who may behave as vultures at different points in time. Hey, likewise, there are startup founders who are not great examples for everybody else to lead. And you just have to pick up any newspaper or just go to any of these blogs, and you will have big stories about all of these failed companies where not just the business failed, but the governance framework failed. So I think we have all of these. Every movie has a hero and every movie has a villain. Just make sure that you're on the right side of the line, and you'll do well.
Yep, yep. So guys, thank you so much for tuning in. Thank you so much for listening to Rajesh and a little bit of what I also said. Thank you so much for that. And also one last thing from my end, I think the startups today should focus more on sustainability rather than growth, because top lines are gone. That was 2021, 22. We are focusing now on bottom lines. So road towards profitability is something that every VC would respect. So that's something that I would end this conversation with. Thank you so much for joining in, guys, again. See you soon. Bye-bye.
Thanks, everybody. Thanks. Bye bye.